Welcome to It Depends, a sales tax podcast by Tax Connects. I'm your host, Brian Greer. Sales and use tax can be confusing and very overwhelming, but it doesn't have to be. Whether you work in industry or at a CPA firm, or just someone who wants to stay informed about the latest sales tax laws, we've got you covered. Periodically, we'll explore different aspects of sales tax. So whether you're a tax pro or a novice, tune in and join us as we attempt to simplify the complexity of the sales tax world. This is It Depends, because with sales tax, there's rarely just one answer, and often that's our answer to many questions. It just depends. We're really going to try to answer a handful of questions. Some of those are really outlined here, but what is an exemption certificate and when do you need them and what level of validation is required when you do receive those from your clients or customers? How often do you need to update and renew the certificates as well? That's part of the certificate management aspect. So hopefully we'll hit on all those topics, all those questions for you. So before I turn this over to Jeff, I thought it might be helpful to describe a little bit about what we're seeing, from an overall, industry perspective. And if you take a step back, and I'm going to take us back into 2018, 2017, and earlier. So essentially pre-Wayfair is what we're looking at here. So if you go back pre-Wayfair and you look at audit activity, and you look at what auditors were oftentimes very focused on, it was use tax accruals. And specifically for the audience that may not necessarily know exactly what I'm referring to, pre-Wayfair, and if a vendor did not have a physical presence in a state, they were not required to charge the applicable sales tax. So in that time frame, we had a lot of purchases where sales tax was never charged. In those scenarios, it was the duty, the obligation of the buyer to accrue the use tax and self-report that use tax. That happened in varying degrees of effectiveness, and the auditors would often look at those purchases to see if sales tax was charged, and if not, they would assess the use tax due. Now, fast forward post-Wayfair, and now we see this scenario where, in addition to the physical presence creating the obligation to collect sales tax, we have the economic nexus standards now. So selling over $100,000 into a particular state, selling over 200 transactions or invoices in a particular state, that's the essential guide for economic nexus. There's some variation, but the bottom line is we have many, many more vendors now with the obligation to charge and collect the sales tax. So what's happening now from a buyer's perspective, the sales tax is getting charged. The buyer has less and less of an obligation to accrue the use tax. So from an audit perspective, there's less and less scrutiny now on those purchases and the use tax accruals. And the auditors are focusing more on the sales activities, making sure the correct sales tax was charged. And the reason for this presentation, really looking at exemption certificates. So when you're claiming exempt sales, making sure that you've got the right documentation and the ability to back up why you're claiming that exemption. That's where we're seeing more and more of the audit focus today. So that's kind of the backdrop for the discussion today. So with that, Jeff, I'll turn it over to you to get into the presentation here.
Thanks, Brian. Thanks. Yeah, I think we see a lot of variety in this area when we talk about exemption certificates, and I think once we get through a few slides, you'll understand that word variety has a lot of different meanings. There's a wide variety of circumstances. There's a wide variety of customer types, transaction types, and thus with all the jurisdictions involved, there's a wide variety of documents that we typically refer to as exemption certificates. I think it's important first, though, to understand what is an exemption in the first place and why do we need an exemption certificate. Well, the standard application of law across those states that charge a sales tax is that any sale of tangible personal property at retail to an end user consumer is subject to sales tax. And furthermore, there are a host of services, usually enumerated services, that are also encompassing a sales tax treatment within a given state. And in the event that transaction occurs in a certain type of scenario or with a certain type of company, the state might afford that transaction exempt status for sales tax purposes, but only to the extent that an exemption certificate exists to substantiate that exemption. So when we think about exemptions, exemptions are exceptions to the rule being tangible personal property and enumerated services are taxable. So it's an exception that eliminates the burden of sales tax applicability on the part of the vendor making that sale. It is, I think, important also, just as a side note, to talk about the difference between an exemption and an exclusion. And we, a lot of times, encompass every transaction that doesn't get taxed as an exemption. But the reality is those products or services that are outside the scope of the general statutes around taxability of tangible personal property and those enumerated services, those other services that aren't enumerated are excluded from tax. And if something's excluded from tax, there is no need for an exemption certificate. It's never taxable to begin with, and so there wouldn't be a need to prove otherwise. So that's why we have this key sort of descriptive difference between an exemption and an exclusion. At the end of the day, you know, we talk to a lot of companies and work with a lot of companies, obviously, that have challenges around exemption certificates. One of the things that seems to be compelling for a lot of companies is how to ask for exemption certificates or when to ask for exemption certificates. My typical response to that is don't. As the vendor, you don't really have any obligation to request an exemption certificate, and you generally don't want to be in the business of directing a customer down one path or another relative to an exemption. That being said, I also, with all the years I've been doing this and working with different companies, I also get the fact that so oftentimes companies, they already have a sense for their customer base and whether that purchase is going to be exempt or not. They it's sometimes very obvious, or sometimes they just have a good sense. And so they don't want to be in that position where they've charged sales tax on an invoice, and a month later, after they've reported that tax and paid it to the jurisdiction, their customer comes back and says, oh, we're not going to pay that tax. We're exempt. Here's our exemption certificate. So I can understand the compelling argument for a vendor wanting to inquire. And I think it's not a bad idea. I just think there's times when it makes more sense than others. And the time it makes the most sense is when there's somebody engaged in the contract or the sales process. And again, here every company is very different. Somebody doing an online sale or transaction real time isn't going to have this scenario. Somebody doing a large equipment transaction for $500,000 might have this scenario, and that scenario being a sales representative is engaging on a contract basis with a buyer, and at that point in time when they're negotiating or finalize the contract, they can ask for exemption certificates. And the ideal scenario is to get that certificate up front prior to the invoice date. That's the best possible outcome that you can serve. And I think at the end of the day, it's the purchaser's responsibility to determine whether the transaction's exempt and to also determine what the appropriate exemption certificate should be, how it should be completed and filled out and executed, and for which state. And we're going to talk a little bit about some of those things as we get into the presentation today. I think the seller's responsibility in terms of exemption certificates is another area of confusion and sometimes anxiety for clients. You know, some of our clients have been through audits where they thought they exercised due diligence or reasonable sort of care in the acceptance of a certificate, only to find out that something they received from a certain customer did not qualify as a valid exemption certificate. So there's certainly valid reasons to have anxiety around that. What we would like to see companies do is use some level of reasonable diligence when they're looking at a document that's been received for an exemption. And understanding the situsing of that transaction is important, and understanding the nature of that state's sales tax exemption process is also important. Nobody expects you as a vendor to understand all the rules in all the states. And so there's essentially going to be a lot of folks on this call today that say, look, I'm selling into every state in the country. I have no idea what the taxability rules are off the top of my head in a particular state. And thus, I don't necessarily know what their certificate looks like in that state, or what it should look like, and what it should say. And we'll talk a little bit about those basic elements of an exemption certificate here in just a little bit that you need to look for and maybe check off as a precursor to accepting a certificate. But these certificates, you should really find a certificate to have a couple of things on it that make you feel a little less anxious. One of those is a signature of the customer. The other is a statement at the very bottom of that certificate stating that they're executing that certificate in good faith and under the perjury or under the case of perjury, and they would be subsequently liable for any tax that would be associated with that transaction. So you should try to ascertain whether or not your form or your document has that sort of language on it. So that's sort of the concept of an exemption certificate, or an exemption in general, I should say. The exemption is applicable to an otherwise taxable transaction, and it's applicable in certain circumstances, which we'll get into next. The categories of exemptions. The one that's most relevant and prevalent would be resale exemptions. So everything that Walmart is buying to put on its shelves to advertise for sale, they're buying that exempt from sales tax. It's tangible personal property. They're buying it for resale. So they're going to issue a certificate that says they're in the business as a retailer and they're qualified to be able to purchase that item for resale. The second, probably more common scenario, is manufacturing. And so the type of business that this customer is engaged in can make a big difference and make a big impact. Manufacturers is probably one of the largest areas, and they make a ton of purchases. They're buying two key components. One is equipment and tooling and supplies to facilitate manufacturing activities, and the other is raw materials that are incorporated into the finished good. Both of those tend to be exempt in the vast majority of the states, or they receive some form of preferential tax rate. So it's a big area. There's specialized exemptions, very specific, whereas resale is fairly broad, pretty easy to evaluate a resale certificate and validate it because it has sort of a basic element to it. Manufacturing could be a little more complicated, and that's true for companies that really specialize in really unique products, usually machinery and equipment or any type of industrial supply or tool. And the reason it's complicated is because all the states vary to some degree in the scope of their manufacturing exemption. Sometimes it's simply machinery and equipment that directly impacts the manufacture of that product. Sometimes it expands to hand tools and supplies, even cleaning supplies or maintenance supplies, and even forklifts that are taking product at the end of the assembly line from that to the shipping dock. So there's a variety of scopes, I guess, that I would characterize exist across the states. And that makes it challenging for a company that's selling to a lot of customers spread out across a lot of states. Again, we revert back to that good faith effort to try to make sure it's a valid certificate. The last category, let me add to the manufacturing, agriculture. Agriculture can be big in certain parts of the country, as we all know, and if you're a business that serves the agricultural industry, you're also going to find there's a lot of unique exemptions available. It could be anything from tractors used directly in the cultivation of products to feed for livestock, or even medicines and things like that for livestock. So there's just a ton of different varieties of exemptions that are available out there. And then lastly, what type of entity are we selling to from a legal entity structure basis? And that kind of serves to cover those things that include sales to government agencies. Typically a sale to the federal government is exempt by statute. You don't necessarily need an exemption certificate if you're selling to the federal government. They're generally excluded and exempt from sales tax statutorily. When you get into state and local government, you then need to get some exemption certificates. And not all states exempt state and local government purchases. So just recognize the rules aren't the same everywhere you go. Similarly, nonprofits tend to get preferential treatment from a sales tax perspective. And in a lot of states, the purchases by a nonprofit are exempt, but again, it necessitates an exemption certificate to substantiate such an exemption. And not all states exempt nonprofits. And lastly, this kind of spans both government and private sector, but educational institutions, there's some private nonprofit educational institutions. There's certainly public educational institutions, so they may fit in either a nonprofit or a government status. But there's also something in between, and there's certainly some exemptions that can apply to educational resources and supplies. So there could be some uniqueness there as well.
And you might be addressing this later in the discussion, but we've all seen scenarios where we've got this process in place and we're going to charge tax to a customer unless they provide us the exemption certificate. It's kind of the tax policy, good policy to have. So then we charge the tax, we immediately report it the next month, client's on a net 30 payment terms, we get the payment from the client, and at the same time they short pay the invoice, and now they give us their exemption certificate. So now we've got this tax that we've charged, we've paid to the taxing authority, to some extent, I guess, in error, but it should have never been paid. What do you do about that?
Yeah, it can be a real challenge for certain types of companies, particularly those that don't have a retail storefront, and so they're selling incrementally to various jurisdictions throughout the country. And in Brian's example there, they may be selling one time to a Louisiana parish, and they may not have another sale of that Louisiana parish for 2 years or ever. So they've got a situation, assuming that they were registered and charged and collected that tax, and then reported and remitted it already, which is Brian's example. There's really not a whole lot of options available to that specific scenario other than to amend the return and pursue a refund from that jurisdiction. So that's that scenario. The other side of the spectrum would be I'll use Walmart again as an example. The Walmart business model is such that they are running credit transactions and returns through their environment all the time. So it's a lot less like what Brian described in terms of getting an exemption certificate at a later date, but the rules and the process sort of mean the same thing. And that means you're going to have a combination of taxable and exempt sales regularly in a single jurisdiction. And so to the extent you've already paid that tax for a sale to one customer who then subsequently issues an exemption certificate, you would then simply take a credit that following month against that jurisdiction's tax liability for that credit that you're issuing to your customer. That's the common practice. Now, I won't tell you that that's not without risk, but practically, typically from a materiality perspective and a cost-benefit perspective, it just makes the most sense to operate and manage it that way. But there's going to be variables or circumstances that kind of fall in between those two spectrum examples, and that can be a little bit challenging. You know, Brian used the example that 30 days later we got the exemption. Sometimes it's 6 months later. Sometimes it's a year later. And somebody says, hey, I already paid you that tax, but we were exempt, didn't realize it. We want a refund. So there are a number of things that can play out that aren't easy to manage. I think the thing that I want you to understand, though, is taking those credits systematically, like I described in the Walmart scenario, does have its risk. And the risk being that the statutes require an amended return or a request for a refund. That's generally the case in almost all states. Not all, but almost all. If you operate the way I described and you get audited, as long as both periods, the period in which you charged the tax and the period in which you took the credit, as long as both periods exist in the current audit cycle of the statute of limitations, you're fairly well insulated from any issues. It's very unlikely the auditor is going to make any issue of it. Statutorily, they could probably issue some penalty and interest on that. They could say you erroneously took a credit, but we're going to give you the opportunity to fix it. So it becomes a valid credit during the audit, but we're going to penalize you and charge you interest for that 1 month or how many months that applies. So there is some risk. It's very minimal risk, but I will tell you, I've had a client in the last couple of years that had an extraordinary circumstance that's very similar to what Brian described, and it was in the hundreds of thousands of dollars. And they just so happened to have executed a similar transaction, in a similar fashion as the way Brian described. And what happened was the audit ended up having a statute of limitations that went back to the middle of that transaction, meaning the audit ended before the transaction's original invoice, but it included when they actually absorbed the credit. And because they absorbed a credit against a phantom transaction from the state's perspective, again, that original transaction is a phantom transaction because the state can't look any further back than the statute of limitations. They denied the quote-unquote phantom credit and assessed them $200,000 plus penalties and interest on something they did not even collect. And so there's some real-world scenarios that get a little risky and touchy. So I think magnitude or materiality are a big part of that equation.
Yeah, so it's the standard. It all depends.
It all depends.
Answer.
So we talked about an exemption in terms of how we define it. We talked about the categories of exemptions, and now we'll kind of migrate into, well, what are the forms of exemptions? What are the types of documents that we should expect to receive? And this is, again, it's a wild card. You know, I like to tell folks that there's an infinite number of forms that you might potentially receive, and I say that with this sort of explanation. Some states allow you to do a custom form. So if any state allows you to do a custom form, and there's an unlimited number of ways that they can craft that form, and it still qualifies a valid certificate, you can extrapolate that to say there's an infinite number of opportunities or scenarios. But let's walk from the more basic forms of an exemption certificate through to that custom sort of certificate. And the first one that most of us are going to be familiar with, if we are familiar with exemption forms, is what I would call a state-issued form. These are common in states like Florida. Florida's sales tax form is generated automatically or systematically for each customer who's registered. And so it's a standard template form. It's a PDF essentially that can be printed or downloaded from the website and issued to the vendor by the customer. It doesn't have a signature and there's not a date written on the form, but those forms are annual forms. They exist for a year. They expire at 12/31. So if you are working with or selling to a customer who's issuing a Florida resale exemption certificate, you've got to remember that's an annual certificate, and you've got to renew that certificate if it's going to apply to your transactions in the following year. We're going to talk a little bit more about record retention and that kind of stuff here in a little bit. The second more common form would be the states publishing a template. They'll have a form number, but it's a template. It's not filled in. It's not pre-populated with any information. And you can go to the state's website, print out this form, and you fill it in. You know, it's a guide. It's a template that requests specific information. Basically, the information that's the takeaway at the bottom of this slide that you guys are looking at, it's going to have the buyer's name, sales tax ID, the seller's name, the item purchased, the reason for the exemption, then you're going to sign and date it. So that's a typical form. A lot of those floating around out there, pretty safe and really beneficial to receive those just because they're pretty straightforward and easy to interpret. Another thing that's fairly common is what we refer to as the multi-jurisdictional form. It's published by the Multi-State Tax Commission, and what they've done is they've consolidated or gotten agreement from about 34 states to allow a single form to represent a valid resale exemption certificate. And it is really simply a resale exemption certificate. So when I was looking or describing the prior form template that the states administer, there could be multiple forms. There could be a form for manufacturers, there could be a form for exemptions, resale exemptions, there could be a form for nonprofits. Some states have a form that encompasses all of those, and it's just an exemption form. So there's a variety. This multi-state or multi-jurisdictional form is specific to resale transactions. And like I said, it encompasses about 34 states. There's some tricks to it. There's about 4 pages of footnotes on the back end of this thing. And so not a bad idea to familiarize yourself with some of the footnotes. Most of the footnotes are not necessary. But in any case, it's a fairly common form when you're a customer that's buying products that are being shipped across multiple states. So you would expect a Walmart to use a form like this. Walmart typically uses their own form, but you would expect somebody like a Walmart who's buying from a distributor, and that distributor is shipping to 40 different states that the product or service they're going to resell. That's the kind of form that would play out in that scenario. There's also what we refer to as the streamlined sales tax scenario, and streamlined sales tax is basically a consortium of states, about 24 of them that participate, and they have their own certificate that can be used in different transactions. Again, mostly resale, but there's some other exemptions like nonprofits that can apply to that as well. But it's very specific to only those 24 states that fit into the streamlined sales tax program. I already mentioned custom forms. They do come in a lot of flavors and varieties. You know, the way exemptions work, not always predictable. For example, let's say you're building a brand new mall in a district in Colorado. You go to the local district or the government agency, maybe a few levels above, and you say, hey, we're bringing this infrastructure to your city, to your district, and we're going to bring this many jobs. We're going to bring this much value in tax revenue. We need some incentives. We need some help offsetting some of the cost of building this out. And they may say, well, why don't we do this? We're going to just exempt all the material purchases from sales tax. And they'll establish a very specific exemption that'll be issued by that local jurisdiction, and it'll give authorization for the general contractor and probably their subcontractors to take that form and go to Home Depot and buy materials for that project exempt from tax. They usually put pretty good restrictions on the use of the certificate, and it's pretty self-explanatory, but it's very unique. And sometimes our clients will get a certificate like that and go, what the heck is this? Never seen anything like this before. So just know that there's a lot of circumstances under which exemptions can apply and certificates can look a little bit strange. At the end of the day, again, we're trying to think about this from a an acceptance perspective, how do we interpret, how do we evaluate, how do we validate that this is a good certificate? And the takeaway, as I just mentioned earlier, is these key elements that should be a part of most certificates that you're going to receive.
Can we accept a resale certificate from a customer who is not registered for sales and use tax within a state if they use another state's ID number on that form? And they've gotten kind of mixed messages. Some states will accept the out-of-state number, other states will deny the out-of-state number.
Yeah, Brian got to ask that question knowing the answer, so I appreciate the way he's leading me down the path. Yeah, Brian could be delivering this message as good as I could, I know. Yeah, this is a very complicated area. So there's a simple answer, and that is yes, it could happen. That could be a valid exemption certificate, but not in every state and not in every circumstance or condition. So what Brian was talking about was a drop shipment scenario. A drop shipment is a big headache for a lot of companies these days. And, you know, when Brian kind of introduced the fact that the economy and the market has changed, and there's really a lot more of what we call remote sellers, internet sales, transactions. There's a lot more companies, small players, who have entered the market that are able to use these platforms, marketplace platforms and other platforms to sell. And in a lot of cases, they're not large enough to require that they be registered. And some of their customers are buying product, they're drop shipping it from a distributor, but the distributor has nexus in that state and is registered in that state to which they're shipping. They're required to charge tax unless they get a valid exemption certificate. Again, the vendor in this case, the retailer, isn't registered in that state, isn't required to be registered in that state. And there are some states that will actually accept that scenario and then that type of a certificate with the home state registration number of the retailer on the form for the destination state where the customer is receiving the product and where the situsing of the sales tax occurs. Probably didn't answer that as clearly as I would have liked, but it's a good example of why drop shipments are kind of so complicated. They're hard to describe and they're hard to kind of follow. The challenge we also see in drop shipment transactions is one side of that transaction has a pretty good grasp of the law and the applicability of that accepting a certificate from a different state, and the other party to that transaction doesn't have a grasp of that law and isn't going to get comfortable. It's not logical to them, and it doesn't make sense. So you can have a lot of conflict in those scenarios. Even though it's a very valid exemption certificate, the distributor may not accept it, say, I can't buy into that. I've been audited enough. I'm not buying that. That doesn't work. But there is some support you can get for that. Brian's active in the IPT model and Institute for Professionals in Taxation. They used to publish an actual book that was a drop shipment matrix or drop shipment guide, and they stopped doing it for a couple of years, and they've revamped that program in an online form. So you can actually go to the Institute of Professionals in Taxation, subscribe to that drop shipment survey, they call it. I think they still call it a survey, and gives you a lot of details and statutory support so that in the event you're actively engaged in those kind of transactions, you have somewhere to go to help you validate the exemption. So again, we've kind of identified what an exemption certificate form is, what it looks like, what are the different varieties of exemptions that exist. And at the end of the day, all we're really trying to do is validate to an auditor that the failure or the exempt treatment of that particular invoice in that particular month for that particular customer is valid. It's a valid exemption. I used reasonable and good faith judgment in accepting an exemption certificate, and that's why I didn't tax that transaction. But to be able to make that representation, you've got to manage your exemption certificates effectively. Getting the certificate and then not managing it effectively is essentially the same as not getting the certificate. In the absence of the certificate, you've got an exempt sale. So again, we talked a little bit about when you get the exemption certificate and how you get the exemption certificate. Ideally, you'd like to have it either before the invoice or at least at the time of the invoice. We know that doesn't happen in a lot of cases. It is okay if you get the certificate a little bit later. Sometimes states will give you a headache or a hard time about the date on the certificate being after the invoice. It's a legitimate issue. It's statutorily an invalid exemption certificate. The date of that certificate has to be prior to or on the date of the transaction. But more often than not, the jurisdiction's either going to give you grace on that or allow you to go back and get a revised certificate. The reality is when they ask you or give you the grace to go back and get a revised certificate, you're going to get a current date on that certificate anyway. So, again, I think it's just trying to do the right thing, trying to be diligent about it, and keeping good records and a good storage function around exemption certificates is absolutely critical. And the larger scale the business is, the more volumes the exemption certificates they have, the more critical this aspect of the business is going to be. You do not want to be the person responsible for managing exemption certificates, and all of a sudden, 3 years later, knock on the door. When they start asking for them, you're not organized. You're not able to provide them. It's a straight assessment, and it's painful. When we start to think about the management of certificates, there's a few things that we have to consider. These certificates are not always blanket certificates. Some certificates you can elect to have applied just to a specific type of purchase. This is very common when we're dealing in manufacturing, because manufacturers may buy anything from an office chair to a very sophisticated laser that's in the quality control process or function. And there may be a supplier out there that supplies both for whatever reason. So when you're in a business that supplies or sells a lot of variety of products and services to particularly manufacturing, it's not going to be unusual for you to get an exemption certificate that only applies to certain types of SKUs, certain types of products that are in your inventory. And you've got to manage to that level of detail. So you've got to be able to set up, and we're going to talk about setup next, you've got to set up that exemption accurately, but you also need to pay attention to those exemption certificates. They have to either provide enough detail to know it's a blanket certificate and that everything I'm selling to that customer is exempt, or it's a one-time or a single exemption. And if so, I really need to pay attention to that and make sure that I have that managed to the right level of scrutiny. The other part of the equation is these exemptions can and do expire. Not always. There are certainly a number of states out there whose statutes will say a certificate once issued is valid until revoked. So that basically says some certificates are valid and eternally. We don't like to recommend managing to that level. I think the wise thing to do is to use a 3-year rule, 36 months. At the end of 36 months, you probably should say this certificate has spoiled and I need to get a new certificate. And this is true when you're working with customers that are long-term customers of yours. You're selling to them frequently, periodically, over the course of years. It's a very good idea to get an updated certificate. A couple of things can influence that, even in states that say the certificates are good forever. That company may start buying things that they're not using in the same fashion they used to. They may have changed their business model, or the statutes may have changed, and now the product they're buying it and the way they're using it is no longer exempt. So if you've got at least this 3-year approach, you're at least giving yourself a little bit of protection, and you're always keeping things a little bit fresh. The Florida example I gave earlier, those expire annually. So you're going to, in January or December of every year, you need to prepare yourself to go out and request those exemption certificates. Don't expect your purchasers to update you with new ones. Once they issue them to you, all they care about is not paying tax. They don't care that you decided to not charge them tax erroneously. So be prudent in that regard. And as I talked about earlier, what happens if I don't have a certificate and I do get audited? Most of the states, most of the time, you're going to be afforded an opportunity to go back and get exemption certificates. But just understand that's not a statutory obligation of the state. The states can deny that exemption in the absence of that certificate. They do not have to give you permission, or they can decline to allow you to go back and get an exemption certificate after the fact. So you are at risk. You are liable. It's only through their kind graces and sometimes just logic that they'll let you go back and obtain that exemption. Another conversation we had, I don't know if this will come up maybe in a question, but if it does, I'll answer it in advance. Another question we have is from companies who are operating across all states, but they don't have nexus everywhere. And they'll oftentimes say, look, I don't have nexus in this particular state, or maybe even they do have nexus. They've exceeded this nexus threshold that Brian described under the Wayfair decision. They've exceeded this economic threshold, but everything they sell is to nonprofits, or everything they sell is for resale. There becomes a position that you end up taking that says, well, maybe I don't register because 100% of my sales are exempt, and maybe statutorily that's okay, maybe statutorily that's not okay. You might be required to register. Regardless, under either of those scenarios, whether you've hit nexus, whether you're required to register or not, I encourage companies to go ahead and ask for and obtain the exemption certificate if you can. If nothing else, it's just an added buffer between you and the jurisdictions and the eventuality they want to make some sort of assertion or claim. At the end of the day, the burden of proof is always on the taxpayer. States can come in and make any number of assertions, and you can be very well equipped if you've got all your exempt certificates in place to be able to defend that. Software solutions are available. There are some programs, there are applications, there are some tools out there that are designed specifically for exemption certificate management. They come in a variety of sizes and flavors. Some are very advanced and serve to assist and facilitate the validation effort on your behalf. Some are very basic, and they're simply retaining or storage type mechanisms to allow you to index and store your exemption certificates for reflection when you need to support an audit. Some of them will integrate with your billing systems such that you can have some decision making happening upon receipt and validation of that certificate. A direct determination is then sent to your billing system to address that transaction. So there's a lot of different tools that might be available. That can be overkill. They're not cheap. And so it's really relevant for those companies that have a ton of exemptions, a lot of variety of transactions through a lot of states. They will end up going down that path.
Jeff, a couple of items just to add to what you were describing. Another risk area of waiting until you're audited and then going back and get those certificates, even if the auditor is kind enough to say, yeah, that's cool, you can go ahead and do that. We know not all those businesses are still going to be in business. And so it's not a great strategy to say, I'll wait and then I'll go get those when or if I need them, because there's going to be companies that are out of business. There are going to be companies that maybe they're not a client any longer and they have no reason to assist you other than maybe their kindness. So it's just not a good strategy in general. The second point, and somebody had asked, I normally wouldn't plug our services specifically, but someone had asked if we sell a licensed technology to manage certificates. The answer is no, we don't, but we do provide a managed service where we have the technology that we run and operate and manage for the client. So we deliver it more as a managed service rather than a software solution that you have to run and manage yourself. So certainly happy to talk about that more offline.
And really, I did say that the importance of the exemption certificate is to satisfy or substantiate the exemption under audit, and that's absolutely true. But there's also transactional elements that need to be managed effectively as well. So you've got to translate that certificate into your billing system accurately and appropriately. The drop shipment question earlier was perfect. You can see in the slide here, it's one of the categories. It is essential that not only are you validating the exemption certificate itself, but that you're validating in conjunction with the invoice that's being issued. So I can receive a perfectly valid exemption certificate, but it not really apply to the transaction because the certificate is for California and the ship to location and it's an FOB destination transaction is New York. Well, a California certificate's not going to work very well in that scenario, except under some maybe potential drop shipment scenarios. Not saying it would work on a drop shipment, but potential. So citusing of the transaction is critical, and citusing rules for sales tax purposes, I'll talk a little bit about that. It's not the purpose of this presentation or the purpose of this discussion today, but I think it's helpful in relation to exemption certificates. So I got to understand the situs of tangible personal property, and that's typically driven by, as I just described, where does the title transfer to the customer? If it's FOB destination, it's at the customer's location. If that's an interstate transaction, I need that state to which that customer is receiving that property. I need that state's exemption certificate. Another scenario might be that I'm selling services. How do I tax services if they are taxable in a state? Maybe I'm performing the service in Georgia, where a lot of services, most services aren't taxable, but I'm delivering that service to a state like Hawaii, where a lot of services are taxable. The question then becomes, do I have nexus as the service provider? If the answer to that is yes, typically it's where that benefit of service is received is the citusing point for that sales tax. So if I have nexus as a Georgia service provider in Hawaii and I deliver that service to a Hawaii customer, I'm obligated to either charge that tax or get some form of an exemption certificate. One of the areas that we have a lot of clients that are impacted by this particular area is SaaS, software as a service. It's very common for companies at headquarters to buy 1,000 seat licenses to a particular SaaS product, and they're disseminating those seat licenses out to all their employees across multiple states. How, as the vendor, do you manage that? And that's a very challenging, can be risky, but more challenging than risky. I'm not going to tell you exactly how to do it because there's different scenarios. All I will say is what we typically are looking for, again, is the same thing. The benefit of service is what drives the tax situs. So in essence, it's where all those users are located. Well, I can tell you, we're not going to recommend that you break down a 1,000-seat license into 1,000 different locations across the country and charge tax on every one of those lines separately and differently. That's not going to be our recommendation. So it's something different than that. We're probably going to advise you use the bill to the headquarters operation as your citusing for that transaction. But that being said, there are what's called multiple points of use exemption certificates. I know Washington State has this. Tennessee has a multiple points of use exemption. A number of states do if you really drill down into their statutes. And what this does is it allows the customer to say, look, I know I'm buying something from you that I'm going to use in the way of SaaS across multiple states. It's not going to be, I'm buying it as a New York customer. SaaS is taxable in New York. But in a lot of the states that my users are located, SaaS isn't taxable. So what I'm going to do is I'm going to issue this multiple points of use exemption certificate, and I'm going to tell you what I'm doing. And I might tell you the percentage that's taxable in New York, and the rest of them I'm going to say is X or not New York, and I'll take on the responsibility of the tax wherever it's taxable. Usually the multiple points of use exemption is 100% exemption. It's taking the responsibility off the vendor and putting it entirely on the purchaser to allocate those seats appropriately and to self-accrue and remit consumer's use tax. So just some weird scenarios and examples of where you need to be cognizant of what that certificate's purpose is as it relates to your invoicing or your transaction. Make sure they're on target with one another. The risk of blanket exemption certificate application can be more challenging in these three scenarios. Nonprofits, there are sometimes things that nonprofits are exempt from, and it's usually products that might go into food products and things that are kind of unique. So just be careful that not always is a blanket exemption going to apply to everything. Manufacturers, I said before, if you're in a business where you sell chairs and you also sell lasers used in quality control type environments, that chair is not being used in manufacturing, and you're not using reasonable diligence in accepting that certificate for that chair. So even though you got a blanket certificate, I would expect or anticipate that a state auditor would challenge you on that and say, you shouldn't have exempted that chair. You should have known that manufacturer wasn't using that chair in manufacturing. And then we've talked again about drop shipments. They are complicated, and you can have a certificate from a customer that doesn't look valid, and it really is. You can have one from a customer that looks valid, but it really isn't. And unless you've really got that drop shipment guide in front of you, or you're using an advisor to kind of bounce those things off of, you can get confused or in trouble pretty quick. Even I don't know the answers off the top of my head. I've read that drop shipment survey I don't know how many times. I don't trust myself. I would go to the survey almost every time. And lastly, the more you can leverage software, some of these things kind of get easier to manage because some of the software elements are constructed such that it keeps guardrails up to keep you from making some of those errors.
I think different than a resale certificate, but maybe you can describe what is a direct pay permit and when can you accept that?
I love that question because I didn't talk about direct pay permits yet. That's a good one. So a direct pay permit is not a common thing. It typically is only issued to certain companies that have fairly large, expansive operations. They are engaged in any number of activities, including manufacturing to other service and processing type activities. They just buy all kinds of things, and in some cases they're inventorying a lot of things that end up being used in different ways. So they may be buying 1,000 wrenches and putting those in inventory, and 90% of the time the wrench is used to tighten a lug nut on a frame for a vehicle that's being manufactured. So it's on the manufacturing line and it qualifies as manufacturing exempt tooling. The other side of the equation is somebody can easily go into that inventory and pull that wrench and go tighten a light fixture in their office. Now it becomes taxable as just tangible personal property. So what happens is these companies that are in these circumstances, they actually go to the state and apply for a direct pay permit. The direct pay permit allows them to buy anything, virtually anything and everything exempt from sales tax. They then are responsible for accruing and remitting the sales tax. You see it fairly common in Texas with the oil refineries. Most of those oil refineries are under direct pay permits. And direct pay permits don't apply to everything all the time. And companies with direct pay permits don't always execute them. They don't always issue them. So just because you might see a company on a website, because I think Texas would publish all their direct pay permit holders, just because you can see that they're there doesn't mean that you can exempt that transaction. You need to get that direct pay permit in hand. But it is a unique exemption and fairly hard to get, not very common. And when you get one, you're going to probably recognize the name of the company. Well, you would anyway because they're a customer of yours, but
they're usually large enterprises, large
enterprises, and they've had to prove their capability to manage their consumers' use tax calculation to the state.
I'm not sure if you're going to know the answer to this one or not, but signatures on exemption certificates. Wet signature, typed in signature versus a electronic signature.
Yeah, I would say that it's obviously with COVID, they had to make some adjustments. I don't know the answer in every state, kind of like drop shipments. It'll depend on the state. I would say that more likely than not, meaning the overwhelming majority of the states, are going to be fairly flexible. If it's an electronic signature, not a wet signature, that's probably going to get approved. Recognize that the auditors have discretion themselves. They're interpreting the exemption certificates as they're looking at them. If I'm selling something to the Red Cross in the state of Illinois, and it's a bad example, let me use another state, Georgia, and they issue a Georgia exemption certificate, and it's an electronic signature, and let's say Georgia doesn't really have a rule that qualifies electronic signatures as valid, that auditor is going to be hard pressed to justify to his supervisor why he put a Red Cross transaction, a sale to the Red Cross, in that audit. The supervisor is going to say, "Are you kidding me? Show me the exemption certificate that you said wasn't valid." And they're probably going to get laughed at, and they're probably just not going to bother. So there's some realities, because a lot of these companies that are doing a lot of issuance of exemption certificates are going to have more formatted electronic signature type scenarios. So you're going to see a lot more of those types from those bigger companies. And the auditors know those companies. Those auditors know they are auditing all these different purchasers of those companies. They see it all the time. So they are going to use a little bit of logic. So you're more likely than not to get that accepted.
Thank you.
Thanks, everybody.
This has been It Depends, with another episode explaining the complexities surrounding sales and use tax. See you next time.